Well, welcome back to ClearCast. I'm so excited because we are starting a new season, and I will be your host this season. You might know me or not know me, and that doesn't really matter because this season is about topics and themes that we're seeing within the housing industry. We're putting together still this bridge between uh, real estate and finance and how prop tech and fintech are working together to solve housing challenges. And so I'm Kenon Chen. I'll be guiding you through this season's fun get together of, I think, a lot of really interesting guests. And I'm very excited at this first episode of the season because today we're going to be talking about housing affordability and some of the solutions that are being worked on for first-time home buyers. And I'm joined by really two friends of mine that I think are super innovative in how they're approaching the challenges of affordability. Today I'm joined by Skye Laudari, who is the co-founder and CEO of Crib Equity, and also by Frank Rohde, who is the CEO and co-founder of Ownify. Gentlemen, thanks for joining.
Thanks, Keenan.
Thanks for having us.
Yeah. So I mean, just so folks get to know you all a little bit better, and I figured you could do a better job of explaining your companies than I can. So Skye, I'll start with you. Like, first of all, what's Crib Equity about? But more importantly, like, how did you um, end up, starting and founding a company doing what you do?
Yeah, thanks, Keenan. I mean, Crib Equity really at its core is about creating more affordable, attainable access to home ownership. And it was a very personal path for me to get into this business based upon my own challenges and eventual success and journey with getting into home ownership. So, rewinding 9 years now, I got married in 2016, and then that was kind of a moment where all of a sudden it was like, wow, we should think about buying a home someday. And that's a goal all of a sudden, right? That really wasn't on the horizon. And realized we were facing an uphill battle. Home prices were continuing to go up every year. I should note we were in the Bay Area, in California at the time, and we just got in this perpetual loop where every year that went forward, we would look back and we would see the Zillow comps and the Redfin comps, and kind of 2 years in the past was what we could afford. And then the next year forward, it was still 2 years in the past, right? And it sort of triggered this realization that if you can't afford to get into the market today, not only do you need to continue to grow your income and your savings to keep pace with the market, but you actually have to accelerate ahead of that market growth in order to eventually get in. And so when our daughter was born, our first child, we ultimately realized like this is like owning a home, having that lifestyle is something that we was important to us. So we moved to Washington State. I joke we bought 2/3 of a California home in Washington, and I think that was this part of this realization for me that for many people the starter home doesn't really exist any longer in its traditional form, particularly in high cost markets like the Bay Area, but really everywhere. And so instead, of being able to that starter home becomes the portion of a home that you could actually own. And so for us, it was 2/3 of that California home that we ended up buying somewhere else. And then the investment that we made in that home in Washington, even in that less expensive home, still ultimately allowed us some years later to sell that home and move back to California. We had the equity growth, we had the appreciation in that home. And so, we moved 2,000 miles to move back 1 mile from the apartment we were renting before we left for Washington. So I think that was a big kind of moment in realizing the opportunity to enable folks who don't have necessarily that huge sum of money to hop into the market, and which we didn't have, and we didn't have the necessarily large family support structure financially to do that either. So, for us, it was really trying to solve this problem around the barrier to homeownership that exists in needing to accumulate substantial savings for a down payment. So, and the implications that has on affordability, mortgage payments, and so on. So, that's really the how I got to this place of crib equity, but it's also the challenge that we're trying to solve for people by providing them with additional capital at the time of purchase. So, we can be the rich parents that you adopt for your home purchase, and put in additional capital with you when you're buying, so that you can make that payment more affordable. You can overcome that upfront hurdle, and we do it in a manner that is substantial enough to actually impact the affordability of the home. So, we can double your down payment and really create this structure for purchase that can work for a lot more people today.
Yeah, that's cool. And you started with a really easy market with California Bay Area is super
Yeah,
affordable.
yeah,
Uh,
it's the epicenter of housing unaffordability, right?
yeah, yeah, absolutely.
Yeah.
Um, no, that's cool when it starts from a personal journey, like that. You know, Frank, where did Ownify come from? And
Yeah, I mean, it's interesting because I have the very similar personal journey, right? I was originally born in Germany, grew up there, and eventually moved to the US, went to college here, had a great job, moved to the Bay Area, and at some point decided, oh, I should, buy a condo. That's kind of the next step. And, I thought I was working for a consulting firm at the time with great income, but really struggled with the down payment. And at the time, my parents helped me. This was 2003 when I bought my first condo here. And, my parents in Germany, middle-class musicians, they helped me with a down payment. And I was able to, get into that condo, and I paid them back a couple of years later. And that kind of stuck with me, right? And then fast forward, I started and then ran a company called Nomis that was building pricing software for mortgage lenders, right? And so I got deep into the bowels of mortgage math, working with a number of the big banks and non-bank lenders in the US, and started seeing this problem more and more, right? That folks like my situation back in 2003, Skye's situation in 2016, right? That was becoming the norm, not the exception, right? And so we dug into this and basically started seeing these statistics that 50% of first-time buyers get help from their family, right? Which is great if your family can help you, but what if you don't have that wealth background, or you don't want to ask your family for help, right? Where's the institutional solution to help first-time buyers, not just with a down payment, but really long-term affordability, right? And so that was kind of the genesis of starting Ownify, was my personal experience, and then seeing this more and more, right? And we can talk about kind of all the drivers that got us to this point, right? Where today, I think I agree with Skye, right? The kind of affordability of the starter home is the exception, no longer the rule, right? And that struggle is real for millions and millions of young people. And so leaning into that and really trying to figure out what are the solutions we can build was a big opportunity, big challenge, quite frankly, but big opportunity and really a worthwhile pursuit. And so that led to starting Ownify now 3 years ago, right, to really build this on-ramp for first-time home buyers as an alternative to the mortgage. And we'll probably dig into how the models are slightly different, right, and kind of the target persona. But the underlying goal here is exactly the same, right, which is how do we help more people into ownership, because it is the way to build wealth and equity, right, and also, quite frankly, to create stability in communities, right, for families. And so there's benefits to homeownership that are really important.
yeah. Well, before we get into your models, let's explore a little bit the problem and the current market, so that we have an understanding of what are some of the main things you are trying to tackle with your approaches. And I was just seeing that I was just reading an article actually that NPR put together around just the change of the ratio between household income, and home prices. And for the United States as a whole, from 1990 to 2023, it's gone from 3.1 being, the home price being three times the household income to now in 2023, 4.8, so now it's, almost five times the household income. And that's just across the United States. And you look at like growth in different areas, Bay Area, since we've been talking about that, San Jose, that gap has increased by 81% from 1990 to 2023. And so, there, I guess, first of all, I guess, like, because you guys are focused on this first time home buyer, I mean, we're not talking about, but we're talking about the average person that has income, right? Has, some means, but is still struggling to keep up with, with preparing to buy a home. Give me a sense of what you see as some of the biggest, challenges, and what's driving, those challenges. Maybe Frank, start with you, since we.
Sure.
Yeah.
Yeah, I mean, there's a couple of real structural challenges, right? The first one is just the supply and demand imbalance. We don't have enough housing in the US. That's the bottom line, right? And depending on what economists and what studies you read, we're short somewhere around 4 million housing units, right? Could be more, could be a little less. But the basic supply demand imbalance means that, prices of houses keep going up because there's more demand than supply. And so you have that, right? The second challenge is the mortgage affordability has been cut in half basically over the last 2-3 years now, right? We were in an environment where mortgage rates were in the 3%, right? And they're now in the 6 and touching on 7%. And long run average, they're in the 5s, right? So we'll probably see some reversion to the mean here, but it's not going to go back to 3% mortgage rates, I don't think, anytime soon. You have, folks living in markets where inflation is real and affordability, not just for housing, but everything else is getting more expensive. So the budgets are getting squeezed, incomes are not keeping up. You have student debt, especially in our kind of target market. That's a big drag on folks, right? You have $50,000, $60,000 in student debt that you're paying off. And then you have basically cash buyers competing against you, right? Whether that's Blackstone or BlackRock or private equity, or quite frankly, the second and third time buyer, right, who has built up equity and maybe has a better financial product than the FHA loan or whatever, combination of financing someone might come in with. And so all of those things are coming together really in an unprecedented manner that we've never seen before, right? And that's been part of the challenge that folks are living through, right? And then, in the Bay Area and in Seattle and in, other markets, you have just the fact that these cities are basically access constrained, right? And we're not building enough, and therefore single family homes are going to be out of reach for the average person,
I'm curious, like, I mean, when you look at the rest of the world and what we have here in the United States, right? There are 30-year mortgage is, sort of the, it's a rare thing, compared to other countries, and it's sort of the envy of the rest of the world. But like, why isn't it working? I mean, it's even at 6 and 7% rates, right? We're not above where it's been historically. But what is it that's missing, Skye, about the current access to finance that's still not, unlocking opportunity for people trying to make their first time home buying story? What's missing in the current system, I guess?
Yeah, it's a great question. I mean, I think we cite all of the same reasons that Frank just touched upon, right? I mean, supply is a huge driver, obviously, in pricing. Unfortunately, when we see a downturn, right, in the market, we saw like the great financial crisis. Home builders pull back, the market picks back up again. Whoops, we don't have enough homes, right? We keep going through the cycle of kind of pulling back on development, and then the market moves forward, and we don't have, enough there. That's a big driver. I think that what Frank mentioned also is hugely important in terms of just the cost of everything else in our lives. So the cost of education leading to student debt, the increasing cost of medical childcare. general living expenses, like rent, right? If you live in a major metropolitan area, your rent is almost equivalent to a mortgage, right? So when you start thinking about the costs that people incur earlier in their career, it's just really hard to save with that in mind, right? And we talk to a lot of folks who are like, hey, I'm paying $5,000 or $6,000 a month for rent. I could carry a mortgage, but how am I ever going to save when I have all these costs, right? So, so that's a big piece. And I think that, to your question about the financing and the biggest and longest term driver, I think, is that wedge that you see in the graph between home prices and incomes, right? So that multiple. And I think the challenge is that, so often when we think about mortgage rates or we think about home prices, like the scale of the chart that we're looking at is kind of daily, weekly, monthly, maybe even yearly. And within those terms, the changes are sort of incremental. But like when you just went back to 1990, right? And if you go back to 1980 and zoom out sort of 40 years and look at the graph over that period, it's a seismic shift, right? So it's that kind of thing where every day you wake up in the morning and you look in the mirror and you look no different to yourself, right? But then when you look at a picture from yourself from a decade or two ago, you're like, wow, I'm a different person, right? And I think that that's essentially what's happened to the housing market. And because of the lack of recognition of that change, the financing tools that we've made available to home buyers haven't changed, because on that sort of shorter term basis, the market hasn't shifted as dramatically. But even going back to the pandemic, I mean, I think actually, Frank, we quote the same number sometimes, that you go back to 2019 or 2020, so it's been 5 years or so, the mortgage price on the same median home has doubled over that period, right? And about half of that change is attributed to the rise in home prices, and half of it is attributed to the rise in interest rates from sort of historic pandemic lows, which are frankly unsustainable. But that, when you think about that, the income you need to qualify to buy a home has doubled in 5 years. That's kind of insane, right? And so I think that in and of itself points to the need for alternative financing, because we sort of hit the end of the runway in terms of what traditional financing tools can provide to a lot of people.
I think there's a couple of, there's a long-term trend here, which is also important to understand, which is this notion that you look at the ratio, and it's probably the best way to look at it, the ratio of median income to median home price, right? And you say, well, it's gone from 3x to 6x or 5x, right, over the last 25, 30 years. And that's the average, right? But then you look at markets like San Jose, San Francisco, the coastal markets, right? Any market that has meaningful job creation, right, and where people actually want to live, those ratios are even worse, right? And so, you can buy homes in places for $150,000, $170,000, but it's not where people are moving to. It's not where jobs are being created, right? And so, as we've had this kind of long-term trend of urbanization, right, over the last 30, 40, 50 years, right, that has exacerbated the problem, right? And so the mortgage, as much as it is a phenomenal product, right, we're the only country where the government guarantees interest rates for 30 years. It's a phenomenal product, but the mortgage has not kept up with that kind of long-term trend, right? And so you have a product that was designed, 50 odd years ago and really 70 years ago, but it hasn't kept up with the affordability challenges, right? And I think part of the problem we're seeing, and this is kind of where both Skye and I and others are trying to innovate, is you've had this structure, right, with a government-sponsored / subsidized mortgage structure for a long, long time, and we really haven't seen any innovation around that, right? And that's an opportunity, but also, quite frankly, one of the shortcomings we're seeing. Right? You look at other markets, right? You look at the UK has shared appreciation mortgages. Australians have figured out, people are building 40 and 50-year mortgages and other ways of buying housing, and we haven't seen that innovation happening in the US.
Is the, I don't even want to call it low-hanging fruit, because all of this is like, I think really notable challenges, but is it more the down payment portion of it that really needs to be tackled first, or is it the ongoing, affordability and monthly, payment, sort of a approach? Do you all see that one is more important to solve than the other, to like kind of thinking of it as like dominoes falling?
So go ahead, Skye.
I was going to say, I think sometimes the challenge is that we often conceptualize those as different things, right? As separate requirements. Like you have this prerequisite for a down payment, and you have your requirement for your monthly payment. But really, those are two. It's intimately tied in the way that our financing system works, right? And so, the more down payment you put down, the less you need to borrow. Typically, the better terms and the better rate that you'll get. And so, when we hear someone say, "Hey, I don't have enough down payment for what I want to buy," sometimes that's the case because sometimes there may just be a minimum down payment for the type of debt financing that you want to acquire, and sometimes it's the case because the down payment that you have means that the remaining debt burden is too much for your income, also, right? So the amount of down payment that you have also affects your debt to income ratio, the rates that you get, the payment that you have. And so, I think we're accustomed to thinking about those things as more, I would say, intricately, connected attributes for products. Like when you even buy a car or something at that level of investment, where you start thinking about, what am I putting down? What's my monthly payment? And you're sort of optimizing those things against each other, because there are more people that can think about, well, do I put $2,500 down, or do I put $5,000 down on a car purchase? There's fewer people that can make that determination of how much they want to put down when you start talking about a purchase that's an order of magnitude larger, right? So do I want to put $30,000 down? Do I want to put $70,000 down? Those are not questions that a lot of people can ask themselves, because frankly, they're constrained in some way on that down payment. So I think we haven't quite conceptualized the connection between those two. So I think it's hard to pull one out and say that that's the challenge from the other. But I will say, as an industry, the mortgage finance, I think, has the innovation that has happened has been to trend towards lower down payment products, and that has created access for people. The challenge is that now, with the disparity in income prices or income and home prices, you end up in a situation where no one can finance that much of their home because the payment's just too large.
Mm-hmm. Mm-hmm.
I'd say so I agree with what Skye's saying. The two are linked, right? The down payment and the monthly payment. I think there's another component here, which is lenders by and large have pulled back, or had pulled back after the great financial crisis, from lending to folks below prime grade credit, right? And so if you think about, what do you need to get into a home or get a mortgage, right? It's historically been, you need decent credit, you need income, and you need the down payment, right? So there are three pieces that you need to put together. And the down payment is a hurdle, the income and affordability component, right? Those are hurdles. But then lenders by and large have pulled back. And if you look at the statistics of what percentage of originations are going to sub 720 or sub 680 FICO, right? Kind of the near prime, subprime space, that has come down significantly since 2008, 2009. Now, you could argue during the great financial crisis, we've gone overboard in lending too much, right? But we're nowhere near where we should be. And so it's gotten a lot harder for people who have even a little bit of a blemish on their credit to get a mortgage. The other thing that happened, and this is kind of a real pernicious situation, is you look at the income spectrum, right? And if you are basically below 80% of area median income, right, you qualify for a bunch of different programs, right? And there are local programs, state programs, federal programs. They're all pegged largely to that income hurdle, right? Because that's where tax incentives are attached, and you, as a lender, you can get CRA credits and a bunch of advantages. And so if you're below 80% AMI, you have access to programs. But the problem is there's no inventory, right? There aren't any $300,000 homes that people can buy, even though they might qualify for those low down payment, or lower down payment options. The real challenge more recently has been for folks who make above 80%, above 100%, above even 120% of area median income. So these are folks who have good incomes, right? They make $100,000, $120,000, $140,000, sometimes more, and they can't qualify for a lot of the kind of programs that are out there, but they still can't get into housing, right? And that's been a persona that we see more and more, right, in the markets we're in. Someone who wants to buy a $300,000 to $500,000 single family home, they have the income, but they can't qualify. It's usually a big part of it is the down payment hurdle.
Yeah, that's interesting. I saw a social post the other day on someone whose medical bill went up once they found out they were insured, because if they're uninsured, they would have gotten credits and discounts on the bill, and so it's this nasty situation of like, yeah, but I earn a good income, which also means I can't qualify now.
Yeah.
So, I mean, in San Jose, the ratio right now is actually 11, uh,
Times area median
11 to
income.
1, right,
Yeah.
for uh, home price to income. Uh, so there's a real problem here. Innovation's needed, both innovation in the actual underlying dynamics of supply and demand, but also from the financing standpoint. So, um, you know, Frank, what is Ownify? What is your approach to you know to innovate in this space?
Yeah.
I'd love to hear from Skye too.
So we've built basically a 5-year program that is a single financing solution where we allow customers to buy starter homes. So generally, it's focused on the $300,000 to $600,000 price tag, right, range. We allow customers to pick those homes, not in San Jose. It really doesn't work in San Jose. I think Skye has a solution for San Jose, so I'll let him talk about that problem, right? But we're in markets like Dallas and Raleigh and Nashville and Phoenix and a bunch of markets. So customers pick the home. We put them into a 5-year program where they're buying equity in the home as fractional ownership. And so structurally, each home issues 10,000 bricks. It's a bona fide security interest in the home. And customers every month make a payment that basically rents a portion of the home and buys incremental bricks over time. And the more bricks they buy, the less in rent they pay, i.e., the stack of bricks they're renting goes down, the stack of bricks they're owning goes up. However, it's not a loan, it's not a mortgage, right? So they're building equity in an unlevered fashion, which means they can't be underwater. They're also protected against repairs. We take care of insurance, property taxes, et cetera. And the whole goal of the program is to get someone into the home with 2% down. So 2% of the purchase price of the home is the customer's responsibility. And over 5 years, we help them get to 10% ownership. And with 10%, we move them into a mortgage. Right. And so in a way, what Ownify is, it's that on-ramp into ownership that allows you to jump over the down payment hurdle. It makes the monthly payments more affordable compared to getting that mortgage with a low down payment and all the insurance, that you might have to pay otherwise. But the takeout really is moving people into the mortgage at the end of 5 years, right? So I call it homeownership on training wheels, right, for first-time buyers with less risk and a lower payment structure than they could otherwise afford.
Wow. Okay. So we're right in the realm of fractional home. Actually, it's kind of what Skye said earlier, which is like, what approach can I take to buy like a little less of the of the home, but still have equity, get me to the point where I can.
And the reason this works, right, is that we partner the first-time buyers with investors who invest in those homes alongside the first-time buyer, and investors participate in home price appreciation, right? So economically speaking, what we're doing is we're saying you don't need to take out a mortgage. If you're sharing your equity appreciation with a pool of investors, then we can effectively allow you to have a lower monthly payment, a lower down payment, right? And so that's that partnership model that works, and it creates great returns for investors, right, who are basically funding that 5-year journey, getting return along the way, getting home price appreciation and income along the way.
Got it.
What I like about that concept of homeownership on training wheels, Frank, is that we see a lot of really concerning data around particularly first-time home buyers. Like I think upwards of a third go into credit card debt after buying a home.
Yeah.
And so if you're, and we think about this too in terms of lowering that cost, right? Letting people reserve more, hold more of their savings afterwards or have a lower payment. But in your case, also, if you're covering some of the expenses of homeownership and really helping people graduate into that, that's a big advantage for folks that, may not quite understand all the costs associated with moving into that phase of life.
Mm. So it helps us with crib equities model and an approach.
Yeah. So I think that at a high level, the easiest way to conceptualize it maybe is to think that we're co-buying without a roommate, right? So you want to buy a home, and just like Frank is articulating with Ownify, you pick the home. We don't get involved in those types of decisions in terms of the actual home itself, or San Jose would be a good market for us, I think, in many cases, because we're sort of driving towards more of the median home buyer or the average home buyer. So today that looks like a 14% down payment for the median home buyer. I think a first-time home buyer averages around 9% now as a down payment. And for us, we want to be able to help them to, in most cases, get to 20% or north. And that alleviates a lot of cost in the transaction for them. So I think, to the point about your down payment and your monthly payment being linked, there's not a lot of, I think, transparency and understanding amongst home buyers about the actual costs of borrowing with the smaller down payment. So obviously you have mortgage insurance, which is pretty well known, but also the pricing on your mortgage will change accordingly. And in some cases, you can see people whether you go from a 10% down payment to a 20% down payment, and your monthly payment changes as much as 25%, which is, can be a pretty staggering number for some people. And so what we're doing is basically providing a shared investment into the home at the time of purchase. So that happens through equity. So it's not a loan. There's no debt payment. There's no monthly payment by the homeowner for our investment. What we do is create a shared ownership structure between a third party sort of silent investor partner. I think similar to how Frank has expressed the opportunity for that investor, and they're kind of going along for the ride with the homeowner, right? They're getting access to single family real estate without acquisition or management cost, and the homeowner is getting the support of that investment in order to make their home purchase more affordable, more flexible, or to retain, in some cases, more capital elsewhere, right? We see a lot of people that are even entrepreneurs or small business owners saying, hey, well, I got to put $100,000 or $150,000 down on this home purchase, but what if I didn't have to for the first time? And I could use that money somewhere else, or I could keep it, or I don't have to pull it out of some other investment in order to make that happen. And really kind of looking at the flexibility of the opportunity cost of using those funds for your home or something else. And so Crib Equity services the agreement and the shared ownership between the two parties. It's a minimum of a 10-year term. It can be longer, but during that time, the homeowner basically manages the home like they would as if they were the sole owner. They make all executive decisions about it. They take all the tax benefits, all the mortgage benefits, if they can, the write-offs. They determine when to sell, when to refinance, when to buy out the investor. All those types of things are at their discretion. And I think that's really how we've approached going to markets that are a little bit higher priced price point, because that's typically where we see the biggest challenge with, hey, there might be those down payment assistance programs or other support programs that can offer you smaller investments in your home, but that doesn't sort of move the needle when you're buying a $700,000-$800,000 $1 million home, which in a lot of areas can now be that starter home. So our ability is to deploy up to several $100,000 into a home purchase in order to help people reach that that number that works for them. So as an example, we've got a gentleman in San Diego who he's in a situation where he's buying a starter home that's just under $1 million. He has 20% down if he really stretches, right? And he's kind of let us know, I don't feel comfortable with that. It's my first home purchase. I don't want to go all in that way. So he's going to put 15% down, and we're going to put 15% down. And so now all of a sudden it's a 70% mortgage instead of an 80. So he's going to keep some savings, have an even smaller mortgage payment. And that's a structure that makes him feel comfortable moving into that ownership situation.
I certainly remember that struggle, and I'm in the Bay Area too, for everyone. I guess we're all gluttons for punishment, but but yeah, it was very much a very real thing of like, wait a minute, I know I wanted to make some changes, to the home, some renovations, some updating certain things, and it's like understanding how much cash you needed to really keep on hand to deal with those unexpected things. I bought an older house, and needed to load all my music equipment in here. That yeah, the idea of like how sustainable am I going to be positioned, right? After I get through this transaction, certainly a lot of worry and time was spent thinking about that. Do you guys see this as what you're offering as are you trying to get people in and out of your programs to move to a more traditional mortgage? You mentioned a 10-year minimum, but is the goal to get them through that process and graduate to a traditional as quickly as possible, or what does that exit, look like for the homeowner?
Yeah. Well, I think the first few years of ownership are always the most quote unquote expensive, right? Those are the hardest
Yep.
because that's one of the advantages of home ownership and a mortgage is that you're locking in a payment, right? You're typically going to continue to see for most folks in their prime earning years increases in wages over time, and so those first years of the purchase are the most expensive. And I think that's when you can benefit from that assistance. So I do anticipate that we see a lot of folks who are looking at this as I'd say kind of a 2 to 4 year bridge, right? That even with modest below market appreciation, 2, 3, 4 years in, there's typically enough equity in the home then to do a cash out refinance and repay our investor. And obviously there's some interest rate risk. If rates double, that's a harder trick to pull off. But in generally, that's a position that I think most folks will be in to be able to take on that additional payment or structure it in a way where it really doesn't change your payment that much in order to take over the full ownership. So I mentioned 10 years. That's the term at which the investor would begin to have a say in what happens to the home. But I think for most homeowners, there's typically an overestimation about how long you'll be in a home. Especially first-time home buyers. I mean, we fell victim to it. We're like, oh my gosh, we own a home. This is it. We're done. And then it turns out like 4 years later, right? You're like, we're ready for a change. And so I think that's sort of typified in the data, maybe outside of the COVID cohort of 2% mortgages. You'll see most people moving out of their homes within the first 7 or 8 years, and then most people even being out of their first mortgage in half that time.
I'd say, I mean, for our program, it's too early to tell, right? We've had homes in the portfolio now for 2.5 years, and they're all still in the portfolio. No one has exited into a mortgage in the traditional sense. I think the question is really dependent on the individual's goals, right? And to Skye's point, it's about how long are you looking to stay, right? If you really want to stay forever or 20, 30 years, the mortgage is the best place, and not having kind of the starter product, right? Probably is best for you. That being said, we also have customers who come in and said, I like this notion of building equity and renting, and I like the fact that you're taking care of repairs and all this other stuff that I don't have to worry about, right? So there's a little bit of maybe alternative motives there as well. And we'll see. I think the goal is to move people for us into the traditional mortgage structure, but that may not always be the right solution for an individual, right? I think a big part of what we've learned early on is that as a first-time buyer, one of the things that, and maybe this is kind of a piece of advice, right? If you're listening to your first-time buyers, like everyone you talk to has an incentive here somewhere along the way, right? And you talk to a realtor, they're looking to have you buy a house, right? And not necessarily the best house and the cheapest house or the nicest house. They just want to have you buy a house, right? And the seller wants to sell you a house, and the lender wants to lend you money, and everyone else has some incentive. So really kind of getting the advice and the education and doing your homework, right? And finding the resources that are out there to say, what is the best solution for me, right? Is it truly buying? Maybe it's renting for a little longer. Maybe it's some, innovative structure like the ones were, or crib equity, right? Providing, and do the research, right? But a lot of, I think the challenge for first-time buyers is it's hard to get that advice. It's hard to get, unbiased, truly good advice from someone who isn't incented to sell you something, right? And the answer often will be very unique and personal, right, to you, and how long you're going to stay, and are you starting a family, and do you have a daughter that's on the way, like Skye, you had, right? Same situation with me, right? All of a sudden you want that extra room. So there's a bunch of things that are very personal.
Yeah, I think, I mean, we're talking about affordability and challenges, and that's kind of the context for the conversation. But I think we didn't, or I didn't, I think really understand the intangible benefits of homeownership, right? The sort of the psychological impact of that, the sense of security, the well-being, at least very personal for me, that ended up being really, really important in our homeownership and creating an entirely different home situation. So I think you think about what is what works for you, what the must-haves are, what the nice-to-haves are. But for most folks, I think there's very few that probably have the luxury of finding just the perfect option in this market, because it is so challenging everywhere. So to your point, Frank, yeah, I think for the first-time home buyer, it's really just figuring out what you are looking for right now, and being flexible about that.
So, I'd love to get maybe then into impact, that you all are hoping to have, right? I mean, this is obviously a worthwhile problem to solve because of all those benefits that come with, helping people get into homes. Last year, I believe baby boomers were the number one generation of home buyers last year, or there were more home buyers from the baby boomer generation than even millennials. Even the millennials is a much larger population of people, which is driven by the fact that they already had a house that they were able to to use the sale or equity of, right, to maybe buy that next house, and as opposed to the first time home buying. So if you two are wildly successful in what you're doing, what do you think the impact really is? What is it that you're going after? And what do the numbers and outcome look like if you're successful? I'm also kind of curious too, like what's your major challenge, right, as a company? What needs to change, right, for you to have that impact as well?
So we look at numbers every day, and ultimately the impact numbers that we trace and look at is how much money can we save the customer up front. And on average, that's been about $29,000 in the down payment savings, right? Of money that the customer didn't have to put into the home, that they can, either they didn't have it, right? They saved it, or they have it and can do something else with it. Average customer is saving about $390 a month in the monthly payment relative to a mortgage. So we have the down payment, the mortgage savings. And then the third number we look at is how much in return are we generating for our investors, right? And that's been 14% annualized return between appreciation and the rental income, right? And so the real goal for us is, how do we build a product and a solution where those two pieces are in balance, right? You're creating real benefit, real impact for the consumer, which means we can help more people get into homes, right? And at the same time, we can attract investor capital and pay investors a fair return, right? So that it doesn't get limited by only impact capital, only tax advantage capital, et cetera. You have market rate investors coming in and consumers coming in. And if we can maintain that balance, then we can help thousands and tens of thousands, and eventually hundreds of thousands of people, and make this kind of equity-based path to ownership a real alternative to people. And that's long-term the goal for us.
That's great.
Yeah, I mean, I think I would echo a lot of the things that Frank said. What I think both of these solutions are actually a very sort of symbiotic relationship between capital and home buyers, right? We know that institutional capital is looking for avenues into single family real estate and residential real estate. It's the largest asset class that there is, right? It's bigger than all public equities in the US, and has very little institutional ownership for a desirable product that's also highly uncorrelated to kind of everything else out there, at least from a public investment perspective. And so, that today has meant a lot of investor dollars moving in direct competition to home buyers, right? As Frank mentioned, you've got all cash buyers, oftentimes investors moving into markets and competing for that home, with an individual or a family. And I think what we're both doing with Crib Equity and Ownify is creating, a better alignment of the capital resources towards, the housing market in conjunction with home buyers, right? So rather than creating a headwind to home ownership, we want to invest with people, or creating structures to help them buy, so that capital is able to be a tailwind to the market for home buyers, and ultimately create the opportunity for both sides. I think in terms of that opportunity, I mean, we look at, depending on the year, the HUD data will tell you there's 300,000 to 400,000 borrowers that are declined because of DTI and down payment, being drivers of their inability to qualify. Couple that with probably a third of all originations that have a mortgage now, all purchases that use mortgage insurance, right? That creates another opportunity for us to be a credit enhancement for our lending partners in a way that reduces the cost for homeowners rather than increasing cost to the borrower. So, to that point, there are, I believe, hundreds of thousands and ultimately millions of people that can benefit from purchasing under one of these alternative programs. The way that I think about ours is, creating that more attainable homeownership or affordable homeownership, but in a way that doesn't compromise the wealth creation opportunity of homeownership. So, that's where we can help that homeowner continue to, retain access to the leverage growth and appreciation that you get from your mortgage, which, is one of the things that makes it such a wonderful investment.
I hadn't thought about that symbiotic, relationship in a way as a counterpoint to the institutional investor versus the consumer. You're talking about how to have the two work together to provide, those opportunities. And, I would think that's something people can get behind. I mean, are you seeing, a willingness to embrace these types of models? Are you seeing more of a growing, I guess, willingness to embrace these types of models as you look at partnerships and things like that on the finance side?
So I think there's a real need and desire for institutional capital to invest in owner-occupied homes, right? And both the Crib Equity solution and the Ownify solution allow that, right? And what ends up happening is, as an investor, you get the benefits of the occupant treating your co-investment, however it's structured, right, as part of their ownership, meaning they take care of the home, they do maintenance, the home appreciates better, it generates less in expenses in our scenario, right? And so as an investor, that's a net positive that I'm not getting if I'm buying a mortgage REIT, and that I'm not getting if I just invest in rental homes, right? And that's one of the reasons why institutional capital is looking at these kind of, how do we participate in the equity and income generating capabilities, right, of residential real estate out there. And, there's different structures. Crib Equity structure is different than ours, but I think that general participation is important, right, for institutional capital. And so it's a way to bring money into solving this problem that goes beyond traditionally the mortgage capital markets, right, and maybe mortgage rates.
Yeah.
I think sometimes we say that no one washes a rental car, right? And so if you're investing in a home for the appreciation and the long-term value, you want someone living in the home, in this case, I think in both cases, who has an ownership position, or an outcome that's tied to the long-term care and maintenance. And so you find that owner-occupied homes receive more consistent maintenance, contributes to longer-term property values. There are actually some really amazing studies. I think Florida State University and Urban Institute have done a couple that actually show that single-family homes, or those that are owner-occupied, appreciate at a higher rate than non-owner-occupied, while and actually down to the individual home level in a neighborhood. So they can show statistically that for each rental property that goes into a neighborhood, home values in that neighborhood will grow at a slower rate. So said conversely, for each owner-occupied home that goes in, the appreciation of that neighborhood increases. So if you want to own appreciating assets in real estate, you also want to incentivize the ownership of of the occupant into that home. So I do think from that perspective, it also yields a really strong benefit to the investor. I think obviously in both these cases, that investor's not going through the high cost of acquisition for a home too, which is a big challenge with building a portfolio of single family homes. You don't have tenant risk, you don't have occupancy risk, you don't have that. Well, maybe in our case, the property management and some of the upkeep associated with it, but those benefits, a lot of those extend across all these models, and it creates the right incentive alignment for everyone to manage towards the outcome. And I think that's also one of the important things when you think about new financing models. And I think Frank's and Ownify's follows ours, which is that it's important to really look at, I think if you're the consumer, is there a scenario where my interests diverge from my partner? Is there an interest or a scenario where my interests diverge from that of whatever this financing tool is, right? Because you don't want to be in a situation where your partner is going to do exceptionally well when you do exceptionally poorly, right? And so we want to make sure that everyone kind of has those aligned outcomes and that the structure is supportive of that.
I love that quote about no one washes a rental car. I will wash a car that I borrow though. If I borrow a friend's car, I will
Yeah.
a lot of times wash that car before I give it back to them, right? I mean, that's
Yeah. I mean, I've never washed a rental car. I usually actually don't even slow down over speed bumps, but
yeah. So I mean, final words. Both of you already given some great advice for home buyers and how to think about it. But any final things that you want to share on ways to even know what your options are?
wow, it's a big question. But I think one of the things I think about it is when it comes to the financial aspects of homeownership and deciding when to move into that, what you want to optimize towards. I think there's a saying more from the kind of investment world that's it's better time in the market over timing the market, right? And I think that if you're looking at home ownership as that tool to create wealth and to improve your financial situation around your housing, I think that holds true also, right? When we look at what it means to get someone into a home sooner, and that sort of math that we've run on, doubling someone's down payment, if we can cut the time it takes for them to get into that home in half, then the years later that would have been their eventual purchase timeline, their net worth is 200% higher, their mortgage is 30% lower as a result of getting in at that lower price earlier and experiencing part of that appreciation over time rather than having to buy all of it later. And so, that getting into the market for a first-time home buyer sooner can be a really impactful change. And so that's certainly one thing that we think about just in terms of trying to figure out when is the right time, hopefully sooner rather than later.
Yeah. Yeah. Frank, what do you think?
I mean, in my mind, it goes back to education, right? And do your research and figure out what the right solutions are. And one of the things that's really, this problem is widespread and everyone is struggling with it. And so many people have come up with creative solutions, right? House hacking is a whole category that didn't exist, 5, 6, 7 years ago, of people, whether that's co-owning through fractional ownership, whether it's using programs, Ownify, Crib Equity, whether it's partnering up with folks. The creativity that's out there is pretty impressive, right? Because folks want to be in homes that they like and and own ultimately. And so I think there's a lot of just creative energy out there and folks solving this problem, and it's all on the internet. It's all accessible, right? You've got your favorite AI bot to help you research that, right? Mm-hmm. It is no longer, let me go talk to a mortgage lender, let me go talk to my local realtor, right, who I maybe met somewhere. There's a wealth of resources out there, right? And it's all out there. It's accessible. So do your research.
Awesome. Wise words. I really appreciate you guys, being on. I think what you're both doing is obviously needed innovation, and I certainly appreciate that you guys are looking at it I think from the home buyer's perspective, right? Because of your personal, approach to it. So, best of luck. Thank you so much for being on the show.
Thanks, Kenon.
Thank you.